Hello and welcome to the latest edition of our Fixed Interest podcast series. My name's Ed Parker. I'm the head of sovereign research at Fitch Ratings. I'm joined today by Brian Coulton, Fitch's chief economist. In this episode, we'll be discussing the latest edition of Fitch's Global Economic Outlook. Brian, the subtitle of the GEO is US Tariff Hikes Loom Large, so why don't we jump in there? Can you talk us through what are your assumptions now on tariffs? What do you see as their impact, and what does this mean for your headline growth forecasts?
Yeah, thanks, Ed. Well, clearly no one knows exactly what's going to happen on tariffs next year when Trump takes office, and the assumption was something that we debated a lot in the team, but I think everybody agreed, assuming nothing happens is not sensible. There's going to be a significant increase in US tariffs. That seems pretty clear. Now, if we were to take Trump at face value, he's been touting these numbers, 60% on China, 10% on the rest of the world, and then he came out with 25% on Canada and Mexico just a few weeks ago. If we take those numbers at face value and apply them to all imports to the US from those countries, you're looking at really something very aggressive, over $600 billion equivalent tax increase, 3% of consumer spending equivalent. We felt that if you looked at how things panned out in the first US-China trade war, Trump did seem to have some awareness of the inflationary impact if he went too far too fast. And so after a lot of discussion, we came up with this approach, which was rather than looking at these tariff rates, the 60, 25, 10, those three headline numbers, which have been repeated again and again, rather than looking at those as if they apply to the total amount of imports, let's look at them being applied to what's called the dutiable imports. So the proportion of imports from, say, China that are subject to any tariffs at all, because 70% of US imports are duty-free. Now, when you look at it that way and you apply 60% to the dutiable imports from China, 25% from dutiable imports from Canada and Mexico, and then 10% to the dutiable base for the rest of the world, you get much smaller numbers. I mean, it's still pretty significant for China because of the share of China's imports that's subject to duties was already pretty large. That was something that went up a lot. But for Canada and Mexico, the numbers are much, much smaller there because very small share of Mexican and Canadian imports at the moment are subject to any tariff. So when we go through the arithmetic like that, we end up, when you go through all the numbers, we end up with an increase in what we call the effective tariff rate. So duties as a share of all imports, an increase there from about 2.3% at the moment, that's the 2023 figure, to a number of just below 8%. So it's a 5 percentage point increase in the US tariff rate. Pretty big, much bigger than we saw in the first episode, because it was just China in the first episode, and we're talking about a bigger increase for China itself, and we're talking about broad-based increases. So it's much bigger than we saw back then when the effective tariff rate went from about 1.5 to about to that 2.3 that I mentioned. In a historical context, it's not so dramatic in the sense it doesn't take the US tariff rate back to where it was in the 1930s. It takes it back to sort of where it was in the mid-60s, so before the kind of wave of globalization that started with a general agreement on tariffs and trade and all those subsequent reforms. We think that's a reasonable baseline, and that's what we plugged into our forecasts. Now, in terms of what it means, we do find when we do a macro model simulation-based analysis of that sort of a tariff increase, it's negative for growth everywhere. Across all the Fitch 20 countries, we've got GDP lower than would be the case in a counterfactual where tariffs don't go up. Now, those numbers vary from, we get a shock of just below 0.5% on US GDP, off of US GDP. Those numbers are much bigger in Canada and Mexico, as you'd expect, and bigger in China. But obviously, in terms of what that means for a forecast, other stuff has changed. So it's not just the tariff assumption that has moved our forecast around compared to the September GEO. And one of the other big, very important developments since the September GEO is the evidence that the US consumer is just really not showing any signs of slowing down at all. And that was our assumption. We thought there'd be a gradual slowdown in consumer spending. It's just not coming through on the numbers. And what we've also seen is some pretty massive revisions to the data on household sector income. And so, we're now looking at a situation where not only is income growth at the moment a lot stronger in terms of the year-on-year growth rate in the latest month is a lot stronger, but the historical data over the 12 months to July the US Bureau of Economic Analysis revised up the level of household income by over $550 billion. So that's enormous. And if we plug in our tariff arithmetic, and what's the extra tax that you would get from the assumption of a 5% increase in tariff, that's 180 billion. So, that gives you some idea of the relative magnitudes here. So we've actually revised up our US growth forecasts, but that doesn't mean that the tariffs are not expected to have a negative impact. We'd have revised it up by more if we hadn't been factoring this tariff increases in. But, and then you're looking outside the US, the biggest downward revisions to our forecasts are for China, Canada, and Mexico. And that's where the tariff shock has really kicked in, because for those countries, we haven't had this other offsetting news in terms of the growth dynamic.
And there's also a lot of uncertainty over the immigration policy of the new US administration and the potential for a marked increase in deportations. What sort of a risk could that pose to your outlook for US growth and inflation?
Well, this is like an even harder one to try and put numbers on, but potentially this is really a really big deal. So, there are estimates out there of the number of undocumented illegal immigrants in the US of 8.3 million. That's for 2022. It's probably bigger than that. It's 5% of the labour force. So if something really radical was to happen, and in terms of the amount of deportations, you're potentially seeing declines in the labour force. Now, the US labour force has only declined on an annual basis once since the Second World War. That was in 2020. It went down by 1.7%. And then that was fully reversed by early 2022. But even that shock, much more mild compared to the potential scale numbers here, caused big labour shortage problems in the US in the pandemic recovery. So you can get some really scary numbers on this quite quickly. But we think maybe a scenario that's been talked about in some of the research on this topic has been looking back Eisenhower in the 50s, and there were 1.3 million deportations over a 2-year period. We've looked at what would that mean for our assumptions about labour force growth. Now, our baseline assumption is that it grows about 0.7% a year. That's based on immigration projections from the Census Bureau of about 850,000 a year. So if you had 1.3 deportations over 2 years, it almost takes that number quite close to zero. So, net immigration goes to zero. Now, if that happens, that growth rate in the labour force goes down to just 0.2, 0.3% a year compared to 0.7 in our prior baseline. And that 0.3 is, would be quite a lot lower than we saw pre-pandemic. So it really would, even on that basis, would have quite a big impact in terms of reducing the growth rate of labour supply. And we think it would lead to a significant tightening of US labour market conditions.
And as you noted, the Chinese economy is in the firing line of US tariffs, as well as facing its own domestic challenges. However, the Chinese authorities have stepped up monetary, financial and fiscal stimulus in recent months. Do you think that's sufficient to restore confidence, stabilise the property market and revive growth prospects?
I don't know if I'd use the word revive, that's quite strong, but it would certainly make a difference. I mean, I think in terms of the tariff assumption, China's the least uncertain in a way. It's almost a slam dunk that he's going to raise tariffs on China very aggressively. So we feel probably most comfortable with that assumption on the tariffs for China of all the assumptions that we've made. And the modelling results would point to a pretty hefty growth shock, over a lot larger than that 0.4, 0.5 that we find for the US. But we haven't revised our growth forecast down that much because we do sense now that the Chinese authorities are getting a lot more serious about macro policy stimulus in terms of the announcements that they've made in the last 2 or 3 months. A lot of which have been on the monetary policy, the macro-prudential side. Not necessarily sure that's going to make a lot of difference, but there does seem to be now a shift in the approach on fiscal policy. So we factored in a bigger fiscal policy response, and that's meant we have taken our forecast down. For 2025, we're down to 4.3% from 4.5 in the last year. In 2026, we're down from 4.3 to 4.0, but we would have taken those forecasts down further had it not been this assumption of fiscal policy. So we do still think that the Chinese authorities have got that capacity to support the economy, and we're now increasingly the view that they will use it and will have to use it if they want to keep growth above 4%. But we think that will happen.
And let's turn to the European growth outlook. There seems to be no end to the negative news flow at the moment, with the prospective US tariffs, the struggles of the German economy and political instability in France. Does this all threaten a recovery in the Eurozone?
Well, this was something that we flagged as a downside risk in our last forecast. And yeah, there's definitely been a lot of negative news. I suppose I would say to maybe temper some of that, the sort of core driver of the forecast recovery that we've had now for a couple of forecasts, the stronger US growth, Eurozone growth next year compared to this year, has been this idea that real household income growth is going to pick up as wage growth has stayed quite relatively high, about 4% on some measures, but headline inflation has fallen below that. So real wages are recovering. We felt that would feed through to stronger labour income, and that would feed through to stronger consumer spending. Now, if you look at Q3, that did actually happen. We did see a very substantial pickup in real household sector income growth, and we saw the strongest growth in consumption in the Eurozone since the middle of 2022. So I think bigger picture, the narrative is still there, but we have revised our forecast down. We're less confident about the pace of the consumer spending recovery over the next year, and we don't think it's going to be as strong. And the reason why is that we're seeing this pretty significant increase in the saving ratio. So households are becoming more cautious. So even though their incomes are improving, they're not increasing their spending in line with that. We've seen the saving ratio in the Eurozone already increased quite sharply in the first half of the year. We thought it would stabilise when we were doing our forecast in September. The data we've had for Germany and France both showed a further significant increase in Q3. So it does look like households are getting more worried about the future. And there are some surveys kicking around that show, particularly an issue in Germany, although it's a Eurozone-wide survey, households are getting more worried about their job prospects. We're seeing unemployment expectations pick up. And I think that's leading to this extra caution, and that's why we've scaled back the consumer forecast. It's still improving relative to this year, but we think it's going to be weaker.
And in the GO, you highlight an expected divergence in the trajectory of Fed and ECB policy rates. So can you walk us through your latest expectations and thinking on rates, and what are the implications of that divergence? I guess a strong dollar is one of them. Does it also potentially contribute to any wider economic or financial stability concerns?
So in terms of what all this means for US inflation and the Fed and how that contrasts with Europe, I suppose, you've got three things going on here in the US economy on the inflation side. The consumer is just not slowing down, so final demand is strong. Backdrop to that is fiscal policy is still very, very loose. I don't think anybody can argue it's anything other than loose. Whether it loosens is an open question. That's not the assumption we've made in the forecast. We've not made an assumption that fiscal policy is going to be substantially looser than we previously thought. We've also got the tariff shock coming, and we've got the squeeze on immigration. So everything's kind of pointing in the same direction as greater upside risks to the outlook for US inflation. We've revised our US inflation forecasts up. However, I still think the Fed are going to be comfortable cutting rates for a bit longer. If you listen to their forward guidance, it's pretty firm that they believe it's still appropriate for them to be reducing the level of restrictiveness, so bringing rates back towards what they would call a neutral rate. So we still think that they'll cut rates later in December. We've still got them cutting rates 4 times next year, but clearly that would imply a slowdown, because at the moment what we're getting is the Fed's cutting at every meeting. They did the 50 in September, then they did 25 in November. We've got them going again in December. We think they're going to slow down and start skipping meetings. So we've got 4 rate cuts next year. And then when we get to the end of next year, we think the Fed is then going to be feeling they've got rates down to a level that we still think is probably a bit above neutral, but they won't want to go any further. And so that's one of the big changes in this forecast, that we no longer get any further Fed cuts in 2026. Now the Eurozone, by contrast, because they're not facing the tariff immigration shock. They're not seeing the consumer strength that the US has got. Core inflation is lower. Services inflation is lower. Services inflation momentum's been coming down, and we've got this negative growth shock now. The outlook for the forecast for growth for the ECBs is going to be like ours. That's going to be coming a lot weaker. And so throwing all that into the mix, you start to listen to more and more Eurozone officials sound like they're getting more worried about the risk that the unemployment might start to rise. And so now we've taken a quite a different view on the pace at which the ECB will cut rates. They've been cutting rates faster than we had expected in September. we think they're going to be cutting rates at every meeting, taking rates below neutral by next July, down to 1.75 on the deposit rate. So that's below our estimate of neutral, which is 2%. So we think they're going to be going faster as the Fed is going to be, slowing down. And as you mentioned, the consequence of that is that as the market has seen that and as reassessed, the dollar has strengthened, and we've also seen, despite the fact that the Fed has been cutting rates since September, we've actually seen US bond yields go up. So it's a pretty important changes for financial markets to digest, and stronger dollar. Be interested in your view on that, what that might mean for emerging markets. It's an important variable, but I suppose on the financial stability side, where I would be looking for risks here is just, we are the 10-year yield is not really heading south. I think, to the extent that it was kind of getting baked into some valuations, that as the Fed started to cut rates, the 10-year would go back down towards 3%. Doesn't look like that's going to happen. So, to the extent we're in this sort of higher for longer world for even longer, maybe that's an aspect.
Yeah, interesting. I mean, in terms of the impact on emerging market sovereigns, well, first of all, there is a very strong historical correlation with a stronger US dollar, meaning weaker average emerging market sovereign ratings. And the key factor here is that a strong dollar pushes up the foreign currency debt and debt service burden of emerging markets, given its overwhelmingly the currency of issue for foreign currency emerging market debt. And then if we think about countries with floating exchange rates, that's going to mean higher inflation and or pressure to keep up local policy rates and adding to the cost of financing. Whilst for emerging markets with more fixed exchange rates against the dollar, then the currency appreciation against a broader basket of currencies could lead to a loss of competitiveness, weaker growth, and a deterioration in the external finances. Thanks, Brian, for your insights, and thank you all for listening. For more on Fitch's economic forecasts and analysis, please visit Fitch's website, fitchratings.com. We hope you join us for the next edition of Fixed Interest.